Have you ever felt like passive income is just this fuzzy, out of reach idea? Well, we are about to fix that. In the next few minutes, we're not just going to talk about it. We're going to architect a real, actionable blueprint that you can use to start building your own income streams by 2026. So let's dive right in. Okay, first things first, let's get one thing crystal clear. Building passive income is not about finding some kind of magic money button on the internet. It's about engineering. It's about building a system. And that means you need a blueprint, you need the right materials, and you need to understand exactly how all the pieces fit together. We're going to turn that vague dream into a concrete, buildable project. So here's our blueprint for this explainer. First, we're going to look at the Architect's Toolkit. These are your foundational resources. Then we'll get into choosing your structure, where we match those resources to the right kind of asset. After that, we'll learn how to read the gauges, to measure performance. And finally, we'll talk about how to fortify your build so it lasts for the long haul. Every single great project, whether it's a skyscraper or an income stream, starts with taking inventory of your tools. And when it comes to passive income, your main tools are your capital, your time, and your own unique expertise. Seriously, understanding what you're working with is the absolute first step. And this right here, this is the fundamental trade-off at the heart of the whole thing. It's pretty simple, really. If you're low on cash, then you're going to have to invest your time and your skills. Things like writing ebooks or creating courses. But if you've got capital to spare, you can make your money do the heavy lifting through things like dividend stocks. It's always a trade, one for the other. So this is where you got to get real with yourself. Ask yourself these 3 questions and be honest. How much money can you actually put to work right now? How many hours can you realistically commit to getting this thing off the ground? And what are you good at? What skills do you have that other people don't? Your answers here are going to point you in the right direction. All right, so you've taken stock of your toolkit. Now let's move on to phase 2, choosing the actual structure you're going to build. This is where the fun starts. We take your personal inventory and match it up with a specific income-generating asset. First step, we've got financial assets. This is the classic let your money work for you setup. Think about things like Dividend Aristocrats. These are solid companies that have a super long history of raising their dividend payouts every single year. Or REITs, which let you own a slice of big-time real estate without the headache of being a landlord. This is definitely the path for people with more capital than time. Now for structure type 2, digital and creative assets. This is for all you builders and creators out there. Yeah, you invest a ton of time upfront to write that ebook or film that online course, but once it's done, the cost to sell another one is basically zero. That's the magic right there. The scalability is just incredible. And last but not least, we have physical and alternative assets. This can be anything from owning a rental property yourself to maybe leasing out some land for a solar farm, or even something as simple as a network of vending machines. These can bring in amazing returns, but they're often a bit more hands-on and can really depend on where you live. Okay, great. So you've picked your structure, the build is happening. But how do you know if it's actually working? Well, just like an engineer, you have to read the gauges. Let's look at some key metrics you absolutely need to track to know if you're on the right path and to manage your risk. One of the most powerful gauges, especially for long-term investors, is something called yield on cost, or YOC. Now, this isn't the current dividend yield you see online. This is the yield you're getting based on what you originally paid for the asset. It's the perfect way to see how an investment that grows its payout becomes more and more profitable for you over the years. And check this out. This is a perfect example of why YOC is so important. Let's say 16 years ago, someone bought Verizon for its nice high dividend. Today, their yield on that original cost is a solid 7.8%. Not bad. But look at the person who bought Visa, a dividend grower. Their yield on that initial investment is now a massive 12%. This shows you how, over the long term, growth can absolutely crush high yield. But, returns are only half the story, right? What about the risk you had to take to get those returns? That's where something called the Sharpe ratio comes in. It's basically a measure of your return after you account for the risk. A higher number is better. So, for example, Bitcoin has a higher Sharpe ratio than the S&P 500, which means, technically, you're getting more return for the risk you took on. But let's talk about what that risk actually feels like. So, over a 10-year span, Bitcoin delivered, wait for it, a 38,000% return. I mean, that's just a staggering number. To put that in perspective, if you'd put in $1,000, it would have turned into $380,000. The potential for wealth creation was just off the charts. But, and this is a really, really big but, to get that return, you had to pay a heavy price, and that price was stomach-churning volatility. To see that 38,000% gain, you had to have the iron will to hold on through multiple crashes of 70% or more. So yeah, the return gauge was incredible, but the risk gauge was screaming red alert. And all of that brings us to our final and, honestly, most critical phase, fortifying your build. Look, it's not enough to just generate some income. You have to protect it. You have to manage the risks, and you have to make sure it's going to be sustainable for years, even decades to come. I love this metaphor. Think about it. Building a passive income stream is like building a dam. It takes this huge, immense upfront investment of either your time or your money. But once it's built, it can generate a consistent flow of power or income. But here's the key. You can't just build it and walk away. It needs regular maintenance to make sure cracks don't start to form. And here are some of those potential cracks. Every single asset class has its own unique risk. For REITs, it's often changes in interest rates. For crypto, it's the risk of a platform just disappearing. For rental properties, it's that phone call about a broken water heater or an empty unit. For digital products, it could be a simple algorithm change that just wipes out your traffic overnight. Knowing the specific risk is the absolute first step to managing it. And speaking of maintenance, don't forget about the tax man. The IRS has very specific definitions for all this stuff. Dividends, that's portfolio income. Rental income, that's passive. But be really careful about this one. If you spend more than 500 hours a year on your quote-unquote passive business, the IRS can reclassify it as active income. And trust me, that changes the entire tax picture. So how do we make this thing grow from a small stream into a river? It's really a simple 3-step cycle. Step 1. Reinvest everything it earns. Let that compounding do its magic. Step 2. Multiply your assets. Use the profits from your first venture to start a second one. And Step 3. Diversify strategically. Don't put all your eggs in one basket.
So there you have it. That's the 4-part blueprint. First, to assess your personal toolkit, capital, time, and expertise. Second, you choose a structure that actually fits what you have. Third, you measure your progress with the right gauges, like yield on cost. And fourth, you fortify your build by managing risk and reinvesting for the future.
We've covered a ton of ground here, and hopefully, you now have a much clearer path forward. So looking at all these different structures, the financial ones, the digital ones, the physical assets, which one of them genuinely gets you excited? Which one feels like it could be the right fit for your personal blueprint? Let me know down in the comments. I'm not kidding. I read every single one. And hey, if this explainer helped clear things up for you, do me a huge favor and hit that like button. Subscribe for more blueprints like this, and make sure you turn on notifications so you don't miss a thing. Thanks for watching.